All right. Hello, everybody. Welcome to my home office. A little bit tidy, maybe not so much. I'm always cleaning this place up. I've got a lot on the go. I got a lot of work that I'm doing, running my financial planning practice with my favorite clients. You know who you are. And also at the same time, working on my Canadian Expat YouTube channel and creating content that is relevant for Canadians who are looking to learn more about financial planning and improve their financial literacy. Networking, lots of stuff. Now, this is my home office where I prefer to do a lot of the admin type work rather than drive to a region office and sit there and do the same kind of paperwork. And reality is a lot of this stuff is virtual and done digital these days. Even if you were to meet someone in person, paper is no these days, and we're doing everything kind of on a digital device. So I do have access to region office as well whenever I need to meet someone face to face. But honestly, I prefer to have nice settings, environments where clients are comfortable. Whether it's at their home or we go to a restaurant or have a chat outside of the regular strategy meetings that we tend to have. And what I thought I'd do a little bit differently today, since it's that time of year, is take you a little bit behind the scenes of one of the client meetings I had today virtually, because it is that time of year in October of, we're in 2024, October, but almost every year and around this time, you might be getting, if you're age 71 in the current year that you're watching this video, a notice or a call from your financial institution to remind you that if you have an RRSP, it has to be converted to a RRIF. And that's exactly the client meeting I had today virtually with a 71-year-old. And we had some technological issues with the virtual and so on, but we muddled through and we got it all done. And this is the video to tell you a little bit about that. What we do on a day-to-day basis. It's not all deep financial planning work. Some of it is administrative work to help clients get things done that is required by law. Like the CRA needs to make sure that you have no RRSPs by the end of the year you're 71. And that can be a very confusing topic. Like, for example, from my side of things, it's a simple process. But I always try to remember, and I'm always reminded pretty well when I'm talking to people, that it is a big elephant in the room of people. They want to get it done, but they're not sure how and what the rules are. And, I'll just put it to bed. I'll take care of it later. And in reality, it's not that difficult, but it can be if you're not in the industry. So I always like to have someone to call for whatever I need. Plumbing, tax, dental, whatever. Like, I'd like to be able to pick up the phone and call somebody and get a straight answer. And for those of you in the financial industry like myself who actually answer the phones and help people out, kudos to you. They are very thankful for that sort of like call a friend line to say, I need help. And so that's what we did today. So, I talked with this client a couple of weeks ago. He knew that he had to change it, was very confused about what we had to do to actually do it. And I told him it's not that difficult. We're going to open up a new account called a RRIF, RRIF, or Registered Retirement Income Fund. We're going to sign some paperwork, and then we're going to move over everything automatically, and there won't be any fees involved. There won't be any taxation involved. And we got to do it. And I know why, and I know all the rules, but he still had a lot of questions like, do I have to do it? What's the penalty? What if I don't need the money? And things like that. And so we went through all of that, and here's a little bit of a breakdown. So until the age of 71, you are allowed to have an RRSP, Registered Retirement Income, Registered Retirement Savings Plan. And most Canadians have one of these. Some of them use it, some of the Canadians use it strategically. Most actually just fall into it through employment, through word of mouth, through people telling them they should have an RSP, through the commercials on the TV and the radio. I'm not saying that you shouldn't have an RRSP, but strategically thinking of when and how to use it can really be beneficial for you going forward, because one of the biggest things that I hear people say is, well, I saved all this money, but in the end I have to pay tax on it anyway when I take it out. Yes, of course, but there's a huge benefit of having the RRSP over decades of tax-free growth, in my opinion. It's helped me, certainly. My RRSP has grown, and I have a plan of how to strategically start taking it out when it comes time for me to do that. But many Canadians, and I spoke with this gentleman today explaining that, my mission is trying to get out also to the youth and the younger generation that might not know what to do with an RSP or not even know about it, and maybe they're just starting with it. If you're not making a significant amount of money, like if you're not earning a huge amount, like your first job is like $30,000, which I don't know what the actual incomes are these days, but it seems like, it's not everybody's getting $100,000 a year right out of university, no matter how much we all feel that we deserve to be getting that money. So if your income is lower, yes, an RSP could be beneficial, but if the idea is to get the most bang for the tax dollar, like the refund, you're not going to get as significant a refund. So depending on what your goals are, for example, maybe to buy a house or for the retirement, depends whether you want to use the RSP or an FHSA or whatever. And this is where you want to talk with a financial professional. But I digress like I usually do. I just have a lot to talk about. So let's go back. And if you want to talk more about that other RSP strategy or planning, drop a comment, let me know you want to talk. Happy to discuss that. But the move from the RRSP to the RRIF is a requirement. And here's the thing, if you haven't been contacted yet, you don't know what to do. Number one, know that from what I know, most financial companies, they will automatically convert your RRSP to a RIF because they have to. Otherwise, they could get in trouble from the CRA, you could get in trouble from the CRA, and I mean like penalties, whatever, and your consultant can get in trouble from the CRA. So if you haven't been reached out to, or you haven't reached out and you haven't done the paperwork, or they've reached out to you and you've ignored it, know this: whether you like it or not, your RRSP will be converted to a RIF. So, why meet with your consultant or your financial planning or your financial firm? Well, the reason is that when it gets converted to a RIF, it gets converted to an account where your pure instructions are kind of guessed at. So with a registered retirement income fund, what happens is instead of you putting money into an RRSP, you now are only allowed to take money out of a RIF. You can't put money into a RIF. And it acts like a pension. And most financial institutions will allow you to take out like a monthly payment or an annual payment. And you might be saying, well, how much is this payment? Like, is it like all my RIF all at once? No. What it is if you're age 71, then on that age, depending on that age, there is a scale, a percentage scale that is issued by the Canada Revenue Agency that says whatever the value is of your RIF on December the 31st of the year that you converted it to, that amount times that percentage is what is paid out in the following year.
So I want to take this quick opportunity to actually show you some of the calculators that we have on our IT Wealth Management website, one of which is the RRIF calculator, which you can access here. And you can put in the information, so put in the RRIF that you have, but let's just use easy numbers so that you can see if the RRIF is worth $100,000. Then we start the RRIF at age 71. That's when we open the RRIF, and we just assume it's going to go to age 90. We can use the spouse's age, if the spouse is younger and you don't want as much income coming out. So that's another planning tool at your disposal. So if you are 71 and your spouse is age 66, we can use the younger spouse to have a less money coming out, and I'll explain that a little bit. Let's change the rate of return to something lower, like 4%. And here's an interesting fact. You don't have to actually start the first payment in that first year. So if it's 2024 right now, you're 71, you convert to a RRIF, you don't actually have to take a payment in 2025. You can actually wait until 2026 to leave more money in the RRIF. So let's just say we're going to take it in that first year in 2025 though. And we're going to get the minimum amount. You can also find that you can actually select a fixed amount, but the fixed amount must be more than the minimum. So this calculator now will tell you that for the first year, if it's, I don't know if it's big enough or not. Let's see if I can make this a bit bigger. Yes, I can. Look at that. Okay, so the first year, starting with $100,000 on December 31st, 2024, the annual payment for 2025 will be $5,280 or 5.28%. And if it's not, and it's at a 4% growth, this is what it's expected to be at the end of the year. So at the end of the year, on December 31st, that's the amount for age 72. Then the next year, it's not 5.28% that should be coming out, it's 5.4. So that's the amount that will come out. And you can see that this is a nifty little calculator to give you some projection. If nothing else changes, basically by age 90, this is a projected amount. Of course, if you can try to get a better return, or if you're not getting a return at all, it's getting 2% because you're leaving it as cash or something like that, you can see that it's still going to have some money at age 90, but the amounts coming out are less. And if you can get a 6% return, well, I mean, we're not going to promise or guarantee that. Anybody will. Anybody will not promise or guarantee that. Or if they do, double check, get their information with a grain of salt. But of course, it's looking better. And then you can always just click on a PDF request to print it off for your files if you like, and have it. It's pretty cool calculator. It
has to be pushed out to your bank account or by a check or whatever in the next calendar year. And if you don't provide instructions on how you want that paid out, well, it could be a check mailed to your address, and it will most likely be done at the last month of the year, so in December of the following year, as a one-time check. If you wanted to have that $5,000 and change spread out within 12 months, then you have to tell your financial institution you want that, and then they will make it out to be an equal portion of the $5,410 spaced out over the 12 months or quarterly or semi-annually or whatever. You can also instruct them to put it into your bank account. Now, the other thing is, if you have a beneficiary on your RRSP, if you don't sign the paperwork to convert it to the RRIF, it's done it for you. That beneficiary designation does not normally move over to the RRIF because it's a new account. So if you had your spouse as the beneficiary, that spouse is not necessarily the beneficiary on the RRIF. So that's another important reason why you want to make sure that you do the paperwork. I mean, what will happen is, if you haven't done the paperwork, if they've automatically converted, someone's going to be calling you to say, we need to sign, we have to do this because there's a compliance also risk that we don't know if we've invested you properly. So if you've got a bunch of mutual funds or stocks or cash or GICs, moving it over automatically means now we have to recheck to see, is this the right investment for you for the next 5, 10, 15, 20 years? And these are all very important considerations. And this is the whole discussion that I had today with this client. In fact, it's one of 3 that I've had so far this year with my clients that are turned 71. And it's going to be more and more. There are going to be more and more people turning 71. I will be turning 71 also in a couple of, oh my goodness, in less than a couple of decades. So there you go. Now, do you have to wait till age 71 to convert to RRIF? Absolutely not. That's just a myth, common myth. You don't have to wait till 71. You can do it earlier. Should you? That's a question for your financial advisor and you to talk about and hope this was helpful, at least give you some things to think about. If you have not done this yet, reach out to your financial professional, call your bank or wherever your RRSPs are, and let them know, hey, I think I have to convert this to a RRIF this year, don't I? And get it done. All right, and good luck. If you have any questions, put them in the comments below. Be sure to take a look at every single one of them and answer them. Have a wonderful day.
The information provided in this video is for general informational purposes only and does not constitute financial, legal, or tax advice. Every individual situation is unique, and it's essential to consult with a qualified professional to get personalized advice that fits your specific circumstances. This content is not intended to solicit or offer financial products or services. The views expressed are solely my own and do not represent the opinions or positions of any organization or company I am affiliated with. For advice tailored to your own financial goals and residency status, please seek guidance from a licensed financial advisor or tax professional.